Well, we've got a couple of commodities experts on the set right now. We are welcoming Daniel Ghali. He's Director of Commodity Strategy at TD Securities to talk about the world of commodities. Daniel, thanks a lot for coming in.
Yeah, thanks for having me.
We began the show talking with John Stephenson about his view on the price of oil, which has come down in a big way now that tensions seem, at least for now, to have calmed down between Israel and Iran. You said in some recent commentary the effect of this war between these two longtime enemies may have actually reduced the floor price for crude oil. Explain.
Yeah, absolutely. I mean, well, listen, first of all, when something like this happens, I try to remind myself that nobody has edge. In predicting geopolitics in a big geopolitical event like this, nobody has edge. So the way that we look at it is by, we analyzed the last 3/4 centuries of geopolitical risk premia in energy markets, and we found that energy markets were actually trading entirely consistent with how you would expect them based on history. The difference here is that heading into this war, the pressure was to the downside on crude, and it's to the downside because most analysts would agree there's a huge surplus that is on the horizon, particularly after the summer months. The issue is that the floor price in that scenario was going to be set by the decline in supply expected at lower prices from price elastic producers such as U.S. shale producers. Mm-hmm. The issue here is that because we've just had significantly higher prices and evidence that shale producers have significantly hedged, then the floor price that we were just discussing is now going to be lower than the counterfactual. Mm-hmm.
Does this lead you to predict lower prices for the remainder of 2025?
Yeah, I mean, as long as the battle lines remain as they are currently drawn, meaning that Iranian oil exports aren't damaged and that Iran doesn't distort shipping out of the Strait of Hormuz.
That was my next question. How important is the Strait of Hormuz, and how important is it that the conflict appeared not to affect shipping in the Strait of Hormuz? There was a collision between two ships that caused a fire, and I assume impaired some shipping out of the strait for a brief period of time, but it was not related to the conflict.
Yeah, I mean, that was absolutely a scary moment for global energy watchers. The Strait of Hormuz is critical. Right, to this day, and in modern history, it's always been critical. It's critical because about 34% of seaborne oil flows through that strait on any given day. It is critical for LNG exports as well, and so really, there's no way for the world to deploy enough spare capacity if the strait was to be closed.
John, your views?
Well, I think that's absolutely true. I said at the beginning of the show, I don't think that it's a serious risk that it will be closed. I mean, it's certainly a possibility. I mean, the Iranian regime has been threatening to close the strait for a long time, so this is nothing new. But I mean, it would hurt themselves as much as anyone. I guess the Saudis more, but for the most part, it wouldn't be good. So I don't know why they would do that. And frankly, I don't think they have too many cards left to play.
Okay, what about gold? Should gold have moved more than it did during this conflict? Typically, would commodities markets expect a move in gold more so than it did during this conflict?
I think it traded very consistently with how it typically trades in terms of geopolitical risk premia. The thing about gold right now is that I think most of the West is actually, there's this perception that gold is a crowded trade, that it's overowned. We actually think gold appears to be technically overbought, but it's actually underowned. And so in that case, thinking about it in terms of how it's traded over the course of the last week, you really kind of miss the big picture here, which is that the US dollar is partly losing its store of value. Gold is benefiting from that. And the outlook for gold from here is exceptionally strong.
Explain underowned. Overbought, but underowned. Explain that.
So I guess when you look at the chart, right, gold's had an exceptional year in 2024. It's had an exceptional start to this year as well. People think that because of that, then it must be a very crowded trade. But the reality, if you get really granular about the positioning data, you find out that macro funds are actually, at very least, flat in gold, meaning they don't hold any. If anything, they might have added some shorts in the last week or so. You find that ETF inflows have been significant. Retail participation in those ETFs is probably at a decade high, but the overwhelming majority of those inflows are a function of a change in strategic asset allocation from institutional investors, which means they're not going to turn around and sell that within the course of a week. So who really has a lot of gold to sell? It's not really clear to me, which tells you, selling exhaustion appears imminent to us, and participation in gold is so low that I have a hard time seeing how we'll trade significantly lower.
You think gold prices will move higher?
We do.
Because they've plateaued now for several months. They've been bumping around 3,400 for a while now. You think at some point there's going to be a sustainable breakout up?
Yeah. But, here's the way we look at it, right? The East fears currency depreciation. That's what drives them to buy gold. The West fears recession and stagflation. That's what drives them to buy gold. The detente on trade has eased both those fears, and in turn, the buying impulse that drove gold prices higher earlier this year has faded. But participation at this moment in time is so low that it's really just hard to see who has more to sell. And you have so many catalysts on the horizon, even as of end of June and onwards, on tariffs, on Fed credibility, on Fed interest rate outlook, and so on, that it's hard to see how participation in gold is not going to rise from current levels.
When I spoke to you earlier this year, you were very, very bullish on silver, and we have seen silver prices rise. They're at more than $36 per ounce right now. Do you see more coming in silver? I think you said that $40 silver was possible this year.
Yeah, we do. Right at the beginning of this year, our silver squeeze you can buy into thesis was premised on this idea that the fear of tariffs was going to drain so much inventory out of London that it was going to challenge the market structure. That has occurred, except on Liberation Day, bullion was exempt. So theoretically, all the surplus metal that moved into the U.S. For fear of tariffs can now move back to London. The issue now is that it's not. It can, but it's not. So why isn't it? Why aren't markets incentivizing that to happen? And we actually think that this is evidence that the financialization of silver as a real asset is prohibiting that reverse arbitrage from occurring. And what that implies is that the only way for London inventories to replenish is through higher silver prices.